Hello students, this is CA Pragnesh Kanabar with the CA Final Audit November 23 RTP. I hope you are doing great. This video is intended to be kept short so that everyone can finish RTP ASAP because I know you are already short on time. When we talk about November 23 RTP, it is divided into two parts. First is the amendments, academic updates, for which I've already given an update in my YouTube channel long back. May 23 amendments have been copy pasted. Peer review, NBFC, profession ethics amendment, audit committee, corporate governance is copy pasted from November 22 attempt. Alright, and there is one small company point of company audit. All of these amendments and stuff are there on my YouTube channel. The description of that, the link of that YouTube channel is given in the description of this particular video. You will find the playlist. When I talk about the questions, what I've done is I've done some marking so that we can be fast with this and you can revise RTP ASAP. When I talk about multiple choice questions, it is a good case study. Alright, so first they have one case study. On that we have 5 MCQs and then there are 3 individual MCQs. When we talk about multiple choice questions case study, so it is NBFC, standards auditing and company audit, mixture of 3 points over here. Now in the case study, the question deals with NBFC. NBFC is a non-systemical important non-deposit taking NBFC, NSI, ND. So it's a NBFC on which RBI is little bit lenient, alright, when it comes to the regulations. Now when I talk about the question, so for the 5 questions, obviously there are 5 important observations. The first observation is over here. Let me explain the business of this NBFC. In the question they have given the NBFC which is involved in refinancing accounts payable. So let us say if X Limited has 10 crore rupees of accounts payable, so X Limited has to pay 10 crores to someone, alright. Then in that case, this NBFC will give 10 crores to X Limited so that X Limited can pay the payables, and obviously NBFC is going to charge some interest rate for giving this amount. But NBFC will pay 10 crores to the trade payables. It will discharge the trade payables of X Limited. That is called as refinancing accounts payable. Alright. Now the auditor, what he is doing, look at this. To test for understatement in existence or valuation of accounts payable, there is a possibility that accounts payable could have been suppressed, alright, thoda kam dikhaya ho, suppressed, okay. Then in that case the auditor decided to test recorded and refinanced accounts payable on a sample basis, alright. So let us say I get a list, alright, of that, okay, this NBFC has paid 100 creditors of X Limited. That list, if I see, if there is something that is missing in that list, how will I come to know about it? For that I have to perform more procedures like confirmation and stuff. Alright. There is if I just see the list, instead of 90, if they have given 100, at least there are 10 fake entries I'll be able to find out. But instead of 110, they have just given 100, the other 10 which are completely missing, how will I find out? So if he really wants to test understatement, he has to do lots of other procedures. Alright. He cannot just be satisfied with this. So to test for understatement in existence or valuation of accounts payable, Mr. Abhinandan decided to test recorded and refinanced accounts payable on sample basis. He just tried to verify refinanced accounts payable against signed contracts. This is not enough to test understatement. Alright, this can be a little bit enough to test the overstatement but not understatement. Alright, so that is the first MCQ over here. Alright, what is the relevant logical evidence? And there are lots of options. First wala, yes, in the current case, testing accounts payable by followed state audit procedure will be relevant for testing overstatement, correct? It cannot help you for testing understatement. So his objective and what he was trying to verify, these were not matching, alright? So it was not a relevant evidence that he tried obtaining. Okay, so that is one point over there. First point. Second MCQ is dealing with net owned funds. I am not reading every single line because I want to ensure that you do it ASAP. Alright. Second MCQ is dealing with net owned funds. So in case of NBFC, there is a minimum requirement to maintain net owned funds of 2 crore rupees. Alright. So if you see over here, net owned funds standing at rupees 2.5 crores. Now there is also one more requirement where the statutory auditor of NBFC has to verify the registration requirements. He has to report it in Caro also, and there is one certificate which is to be signed by the stat auditor. Alright, that he has verified this, and that certificate needs to be submitted. Alright, so that is one point over there. Okay, which is the very first option that they have given over here. All right. If the net owned fund falls below below the prescribed threshold limit, then there is also one exception report that gets submitted. All that is fine, but there is one certification which compulsory needs to be given on the registration and net owned fund requirement. Certificate with reference to this position, all right, is required to be submitted. That is the second MCQ. When I talk about the third, fourth, and fifth MCQ, I think students will find it very simple, all right, because it is dealing with this paragraph. But normally, I've seen final C students very clear with that. So basically there is one fraud committed, all right, by the employee of the company. Now even NBFC is covered under Companies Act. So section 143 subsection 12 of Companies Act 2013 is obviously applicable over there. 4 crore rupees fraud needs to be reported first to the company and then to the central government. Section 143 subsection 12, duty to report fraud to the central government. So that is one point that they have questioned. I'll just show you that MCQ. All right, this third point, 143 subsection 12, duty to report fraud of 1 crore or above, right? This whole section point, 10 crore wala no, all right. So this particular point, all right, is the right answer over here. Okay, then there is one more on this fraud reporting. Look at this, fifth MCQ. So basically what that they have created a situation that within 2 days, if he reports to the audit committee, the board of directors, so when there is audit committee, obviously you should report to audit committee. Until 45th day, if there is no reply, then the provision says that you need to straight away forward the report to the central government saying that you had reported and there was no reply. All right. So that is the point over here, and students are fairly comfortable with that. So I don't see any problem over here. Okay. Now what happened is, because one employee committed a fraud, I repeat, because one employee committed a fraud in this NBFC, the customer of NBFC had to pay a lot of amount. All right. So because customer had to shell rupees 4 crores. All right. Fraud is of 25 crores. Sorry. So customer had to shell an amount of rupees 4 crores. Now because customer had to shell an amount of rupees 4 crore, customer has decided that he may file a case against that NBFC. Okay. Now if customer is going to file case against the NBFC, then there is going to be a matter of litigation and stuff. All right. So these things, this whole situation has not been disclosed in the notes to accounts. See, I understand that the legal case has not yet been filed, but at least it needs to be disclosed in the notes to accounts, correct? All right. If they are not even disclosing it in the notes to accounts, then it will be materially misleading. I understand that the whole financial statements is not misleading, but still there is a material misstatement. All right. So that is one point, okay, over here, which they are covering in the fourth MCQ. Okay. That boss, it is material but not pervasive. There is no disclosure in the financials. All right, at least a qualified opinion needs to be given. Right? So that is one point regarding non-disclosure. Okay, go fast with this. You do not read every single line over here. You may not have a lot of time. Okay, so as you can see, the answers are the first A, then A, then B, then B. And then over here, he needs to straight away file a report to the central government. All right, if he fails to get a reply. So you can see over here A, B, B, C. Correct? Now, independent MCQs. I have done a little bit of working students because I wanted to keep it very quick with you. Now, sixth MCQ over here is on tax audit. Now many students are worried about tax audit. Let me be very clear. You cannot buy at every single clause. There is one reading of Form 3CD, and you should have little bit background of taxation subject. Even if you are struggling, then in my mobile app I have unlocked the videos on tax audit and audit committee. Normally these two topics students are not comfortable with. So in short, you can cover it up from there also. Now what has happened over here, that in case of taxation of firm, all right, there is an adjustment with respect to salary paid to partners and stuff which may be inadmissible, right? So there is a net profit before tax is 15 lakh rupees. Now annual salary that is paid to the partners 2.5 lakh per month into 12 is equal to 30 lakh rupees. So 15 lakhs plus 30 lakhs is 45 lakhs. This is how you calculate the salary amount to understand how much will be admissible, how much will be inadmissible. So this 45 lakh is the book profit. I'll divide into 2, 3 lakhs and 42 lakhs because on the first 3 lakhs, all right, either 1.5 lakhs or 90%, whichever is higher. So 2.7 lakh over there, which we are admitting the amount, and out of the balance 60% can be given as an admissible amount. So 25.2 and 2.7 comes to 27.9 lakhs out of 30 lakhs which will be allowed, and 2.1 lakh is going to be disallowed over here out of the 30 lakh salary that is paid, alright, which is not admissible. I'll not use the word disallowed, I'll say it is not admissible. This amount is not admissible, alright. So that is the point that they have taken up over here. Now this particular MCQ is very simple, alright, about physical verification of inventory. You know that, boss, due to unavoidable circumstances, if you're not able to attend stock count as on year end, then I can understand that you're doing it digitally and video call and stuff. But just because you're suffering from some some sunstroke problem, and you say that, oh my god, it's so hot outside, I won't be able to attend, alright, then in that case I will not allow you to do that physical verification digitally. So that point they have tried covering over here, alright. That was, this person has just done it digitally and there is no reason for that. Okay, so procedure adopted by auditor is in accordance, no, it is not in accordance. Okay, so it's not in accordance with standards auditing. He can skip the, because he can skip only when it is not feasible, alright. Threat to your safety, or the location is not accessible, alright, war type situation, pandemic type situations that we have all gone through, alright. 8th point is very simple. Why do you have password? Why do you have password on your laptop in your application and stuff, alright? So that to ensure that there is no, that unauthorized access is prevented. So it is more like a preventive control, alright? Application based controls is a very general word, whereas preventive control is very proper word over here. Application based controls means inside the application. Alright, inside the application, in the whole processing of the controls that are placed are application based controls, and general controls are your controls over database, overall IT system, server and stuff, right? Okay, so that is the point. That is why over here user ID, password and stuff, it is a preventive control. So the last 3 MCQs, as you can see, B, C and D. B, C and D, that is the answer that they have given. Alright. Now when we go to the brief answers, a little bit of tough questioning has been done in case of audit of banks and a little bit on tax audit and stuff. Otherwise the questions are very much manageable. In question number 9, basically management is using the work of an expert and the auditor wants to evaluate the objectivity of that expert. That means whether that expert is going to work with an unbiased free mind or not. Now if you really want to evaluate the objectivity of the expert which has been appointed by the management, you need to see whether he is an employee, whether he is an outsider, alright, I mean the external person engaged, what kind of interest he has, the financial interest, the personal interest, alright, what kind of other services he has been providing, for how many years he has been auditing over there, alright, whether that person is a member of some qualified body, because if he is a member of a qualified body, then in that case there will be some pressure on him to maintain ethics. So that's a little bit of general answer. You can read once and I'm very much confident that students can write on their own over there, alright. So in that particular answer, the material part is this part, okay. The problem over here in this question is that again and again that same expert has been appointed, so it creates a little bit of familiarity threat over there, okay. Question number 10. Since many attempts this question has been asked, so it is dealing with compliance with laws and regulations. Now SA 250. Now management needs to implement certain policies and procedures to ensure that they do not end up not complying with laws and regulations. So basically they should comply with the laws and regulations. So if you are the CFO or CEO of the entity, tell me what kind of policies, procedures you will adopt. You maintain proper registers, records, train the employees, develop a code of conduct, alright. So those examples are there, but this is a very much their favorite examination question, alright. So I think students are anyways, from wherever you have studied, you would have gone through this answer because it is a very repeatedly asked examination question, alright. Then when it comes to company audit, 11th question on CARO is a fairly simple question, alright. So over here XYZ Limited is controlling AT Private Limited. So this is the holding company, this is the subsidiary company. Now subsidiary company has given a negative remark, alright, in the CARO. Subsidiary company auditor has given a negative remark in his own CARO, alright. Now holding company auditor is going to prepare 2 CARO. One is CARO on standalone FS, CARO on consolidated financial statements. For CARO on consolidated financial statements, first 20 clauses there is no comment. Only in clause 21 you have to comment, alright, that boss, if there is any negative remark given by the auditors of the subsidiaries in their CARO, then you have to consolidate it and copy paste it and write it in clause 21. So that is the point that they have covered over here, okay. So they are explaining first applicability of CARO on CFS is only for clause 21. Then they're explaining what is clause 21. All right. And then what will be the responsibility of the parent company's auditor. So fairly simple question. I think students can easily tackle it. Now, when it comes to this audit report question, all right, there is one question from SA 700 that they have taken. The concept of supplementary information. For the first time it was questioned in July 21, and then later on in many RTP MTPs they have taken it up. I also take it in my essay basics on YouTube revision, everywhere it is there. What is supplementary information? Additional information which is not a part of the financial statements, but still management has prepared it. In that case, auditor needs to evaluate whether it seems to be an important part of the financial statements or not. If it seems to be an important part of the financial statements, he will cover it in his audit opinion. If it does not seem to be an important part of the financial statements, then he will not cover it in his audit opinion and request the management that the supplementary information should be presented in front of the shareholders in such a manner that there is a clear difference between the audited financial statements and supplementary information. If management is not adhering to this difference, then in that case I can write it in my audit report that this particular supplementary information has not been audited by me. All right. So that is the point that they have covered. You can go through the answer, and they have taken the stand that was such kind of supplementary information should not be covered in the audit report. Okay. In SA 700 module, so they have given 1 or 2 examples if you want to refer those examples. Anyways, it is one of their favorite point. Now in question number 13, what has happened is that there is a material uncertainty over going concern that they have already given in the question. Now when there is a material uncertainty over going concern, management is expected to give disclosures in the notes to accounts. When they do not give the disclosures, there are two let us say, I'll just write it over here. There are 2 possibilities. Either they will give the disclosures or they will not give the disclosures. If they give the disclosures, we'll write it in a material uncertainty related to going concern paragraph. If they do not give the disclosures, there are 2 possibilities. Sometimes they just leave it with something relevant but incomplete. Right? Like there is a legal case and stuff, but they are not writing about material uncertainty or going concern. So they have given disclosures but incomplete disclosures. Or they have completely omitted the disclosure or completely given irrelevant disclosures. If they have given disclosures but incomplete, that means thoda such bata rahe, thoda nahi bata rahe. Then in that case, you can go with a qualified opinion that has been given in the module, and I have shouted at the top of the voice and taught my students also. However, if they have completely not given the disclosures, that means they are completely misleading the financials. Alright. Then in that case, you can go with an adverse opinion because the overall financial statement is misleading. If you are not comfortable with these concepts, alright, in that case you must watch my essay basics revision video and also essay 570 videos. All right, only then you will get a complete grip over this. Now this particular point is just explain the difference between emphasis of matter and key audit matters. In my description I have given a revision playlist. If you want, you can go through the essay basics, but basically key audit matters is there for listed entities. Emphasis of matter can be used across all the entities. That is fine, but key audit matters are matters communicated with those charged with governance, and only matters of utmost significance are communicated as key audit matters, whereas emphasis of matter is purely for accounting clarification. So whatever has been disclosed in the notes to accounts, financial statements, which is properly disclosed, but still if I want to write it, then I will use emphasis of matter paragraph, and then the difference between them, how to select, and all of that I have explained in my essay lectures in great details in the lectures and in a revision form in the revision lectures. All right. Next is audit of consolidated financial statements. So basically they are talking about, see in CFS there is one major question where they will discuss about exemptions from the CFS, as per section 129 AS 21 Ind AS 110. Basically just go through my revision video if you're not comfortable and solve module question bank. That is more than enough. But listen to me. As per Ind AS 110, if the company is an investment company, what is investment company? Alright, I will take money from you, I will invest it in various companies. I may end up holding 55%, 60% and stuff, but I don't want to control them. I'm just investing in them, alright, and I'm showing it actually as my investments, alright, and I'm valuing it at fair value. I'm going to exit the moment I get good money, alright. So actually there is no control over here. Based upon that logic, Ind AS 110 is giving you an exemption, alright, for investment company. Now in this question, what has happened is that this company is following Ind AS and it is genuinely satisfying the criteria of investment company. That is why there will be an exemption from consolidated financial statements. However, as per section 129, there is no such exemption given. Okay? And that is the reason that they are saying that apply the exemption as per Ind AS 110. But when they will prepare the financial statements, they need to write it in the notes to accounts that these subsidiaries have not been consolidated because of the exemption applied as per Ind AS 110. Alright. So that is what they are trying to say in the answer. Audit committee and corporate governance, I have shouted at the top of my voice that this chapter students are not that comfortable. However, if they just go through what is audit committee, role of audit committee, applicability of SEBI LODR, then board of directors composition in various companies and various committees, all right, and their composition, and last point of audit committee corporate governance certificate, all right, corporate governance certificate to be given by the auditors. If you just go through these points, it is more than enough, and then the module questions, then you can skip the balance chapter because it is really not humanly possible to remember every single limit. And I have been saying this since many attempts, and as you can see, they are also focusing on those areas only. So board of directors composition and various committees. See, this is a factual answer, all right. So for factual answer, you should know the provisions, all right. Now, if you see over here, top 500 listed entities they have taken into consideration. Board of directors comprise of total 5 directors. No, for top 2000 it is 6 directors. All right. Then independent directors did not hold any meeting without the presence of non-independent directors and members of the management. No, they need to hold at least one meeting in a financial year, all right, without the presence of these people. All right. Risk management committee of AB Limited devised a policy on board diversity. See, risk management committee is supposed to analyze the risk involved in the processes and stuff, whereas it is the nomination and remuneration committee which needs to draft a policy on board diversity, nomination, remuneration. Chairperson of stakeholder relationship committee is an executive director, right? Top 500 mein no boss, it has to be a non-executive director. AB Limited quarterly compliance report was submitted quarter ending 30th September 22 on 25th October. No, it needs to be submitted within 21 days. So by the 21st of October it needs to be submitted. This is not a proper date. I mean, there is a delay. Then in the 16th question, they have given some points over here, all right, and they have given some role. They are saying that this role is performed by which committee. The first role of subscription of rights issue and all complaints by the shareholders is covered by the stakeholder relationship committee, and then this IEPF also covered by stakeholder relationship committee. Then evaluation criteria of committee and the directors is nomination remuneration committee, and approvals for related party transaction is audit committee itself. All right, so that is the point. I am telling you these points. If you are comfortable, audit corporate governance certificate module questions and the first part of applicability and audit committee, then that should be more than enough. Okay. Audit of banks. This is a special emoji drawn by me because neither in the existing module nor in the new syllabus module, which is going to be applicable from May 24 onwards, that they have covered the concept of NPS in these great details. So you are just covering basics of audit of banks, and then all of a sudden you want students to be Chanakya, when they are answering on NPS. All right. Anyways, I'm happy with the level of question, but if the level of study material was also such, then we could have gone with this. So basically, let me explain you the concept of gross NPS and net NPS. Gross NPS are the total loans which have been defaulted, all right, overdue more than 90 days and stuff. That is gross NPS. Obviously, for all the loans which have been defaulted, correct, there will be some kind of provision that bank would have made. So those defaulted loans minus provision comes your net NPS, correct. Net NPS is the actual loss that the bank will suffer in case of the defaults, correct. Net NPS to net advances. So if net advances are 100 and 1.72%, let us say, and 1.72 is net NPS. That means out of 100 rupees net advance that you are giving, 1.72 is anyways the loss that you are taking. All right. So that is not a good ratio. All right. The higher the ratio, this is the worst position it indicates. Now I explained you the logic. That is exactly what they have asked in the answer. Now if you read the answer, you will come to know what they are trying to say. All right. Okay. Question number 18 is just a normal question on internal control. I have said this, that in case of audit of banks, if there is a question on internal control, all right, then you have to just practically think about it and write 3 to 4 points. If it is a 4 marks question, you will not get more than 2 marks. All right, but you cannot prepare too much for this. You should just know the system. Abhi dekho, this in over here, the bank is worried about credit appraisals and credit monitoring. What kind of policy they should have? So they should have some kind of detection system. They should have appraisal system. All right, they should have a database through which they can get the credit ratings and stuff. All right, so that this is the point that they are talking about. Okay. Now in question number 19, it is about audit of insurance. Last attempt for audit of insurance is November 23. All right, full respect to you students that instead of having the dolly of May 24, you are actually going for November 23. I really respect you. Anyways, I want to finish RTP fast. So question number 19, one insurance company is thinking about transferring some risk to another insurance company, because it has taken too many policies, so they want to transfer a little bit of risk to another insurance company. Such arrangement is called as reinsurance arrangement. There are 2 types of reinsurance arrangement. One is facultative reinsurance, another one is treaty reinsurance. Facultative reinsurance, I am transferring you the risk, but we will not enter into any automatic arrangement. That means 20% of fire risk. No, No such automatic arrangement. All right? No such binding arrangement. We will negotiate every single risk individually. We will negotiate every single transaction individually. So I'll have to set up a department, you will have to set up a department, and for each transaction we'll keep on negotiating. That is facultative reinsurance. Treaty reinsurance, we will enter into a binding agreement that for the next 2 years, all right, 20% of fire risk policies will be reinsured. I mean, I'll transfer the risk to you. So that they are talking about, you know, facultative reinsurance and treaty reinsurance. Audit under fiscal loss, tax audit, again everyone feels pain in the and May 24 onwards, I'm very happy that they have shifted this topic to direct tax subject because it should go with that. So I'm telling you again and again, for tax audit, just form 3CD broadly what is covered. You should know taxation provisions from your inter CA or final CA. All right. You should know taxation provisions. All right. And then you can just go through the module questions and finish it off. Beyond that, you cannot do anything for tax audit. Okay. If you have worked in tax audit, then fine. Now, when it comes to tax audit reporting requirement, basically they have given a long question where they're talking about, you know, contribution by the employer, contribution from the employees regarding the various funds and stuff, you know, that are kept for employee benefits. Now, taxation part is fine. All right. I know that contributions received from the employees, you know, they can be allowed as a deduction if it is for these kind of, it will not be considered in their income if this is for this kind of contributions. All of that is fine. But the main thing is that in tax audit report, an auditor is not expected to evaluate so much of thing, all right, when it comes to these contributions. Because there is no investigation going on over here. In tax audit report, the clause specifically wants the auditor to just keep on reporting these figures. Right? So if I just properly report the figures and state all the facts, all right, then in that case my job is done, at least with respect to this particular clause. So that is the main gist that they have covered, all right, in the answer. If you see, I have not gone through the answers since a long time. I explained all of these answers in summary to you. Huh? So only when you feel that chalo ye answer read kar lete, you should read it. Otherwise, there is no need of reading every single answer. Okay. So this is the particular paragraph which is the most important paragraph over there. Alright. Now, liabilities of auditor, again a long question has been given. See, for liabilities of auditor, the chapter is divided into two parts, theory and section. Only the section part is important. Alright. Say liabilities under Companies Act and Income Tax Act and all of that. Now this is a long question, but at the end of the day, they are talking about, they want you to tell them about what are the powers with the National Company Law Tribunal for removing the auditor, for changing the auditor. Alright. So that is section 140 subsection 5, tribunal on receiving an application or even suo motu on its own can conduct an inquiry against the auditor. If it finds that auditor has acted in a fraudulent manner, then they can pass an order for, asking for the change of auditors. That is one point that they have covered over here. The main impact on the auditor over here will be that he will be not allowed to audit the financial statements of any company for the next 5 years. All right, and obviously there can be an action under section 447, penalty for fraud. That is the point. Okay. Now the next question is on internal audit, management audit and operational audit. Now over here they have described one issue which is being faced by the company. See, first of all, internal audit is audit of internal controls. Management audit is audit of management and managerial decisions, managerial efficiency and stuff. Operation audit is audit of operations like printing and stationery operation of a coaching class, how we can improve that particular operation and stuff. Economy, efficiency and effectiveness of operation. So in the question, there is some problem that the company is facing, but company is not facing that problem because operations are not good. Company is facing this problem because of the long decision making cycle. And that is why we will recommend management audit over here, all right, and no other audit. So you have to explain the difference between management audit and operation audit, and then you have to say that I am going to recommend management audit in this case. So that is what they have done. All right, management audit would be recommended, and this is a copy paste of module question. Then investigation, due diligence, and forensic accounting. Forensic audit word has now been replaced with forensic accounting. Now there is a question on investigation. I have explained this into my batches in the student to the students also in my batches. Alright, we do discuss these kind of topics because we know the importance. Basically, let us say investigator is facing some issues over here. Whether he should go for 100% verification or he should go for selective verification, that depends on the assignment. If the assignment is of cash misappropriation, then I'll have to go for 100% verification only. Only then I'll be able to detect the misappropriation. However, if the assignment is of some valuation or so, then in that case we can go for selective verification. Whether investigator necessarily requires the assistance of expert, again depends on the assignment. If the assignment is such that I have to verify raw material efficiency, consumption and stuff, then I may need the help of an expert. Otherwise, I will not need the help of an expert. But we need to settle the cost of appointing an expert. That who is going to appoint an expert, whether the investigator, client or so. Okay. whether investigator can retain the working papers or not. He should retain the working papers for as long as he feels that his investigation can be questioned. All right, and adopting a standard quality control practice, he should retain it for 7 years or so. So that is the point that they are trying to cover over here. The issues that are faced. All right. Next is on peer review, quality review. Although a couple of questions are on quality review, but I'm expecting questions can be on peer review in the paper. You should be very much clear with the amendments, and peer review amendment full video is there on YouTube. So peer review, quality review questions over here. Question number 24A is on quality review process. Wait, now what is quality review? There is one quality review board set up by the central government, which will select various audit firms and entities whose auditors need to be investigated. All right, they focus only on stat audit. Then they will appoint a technical reviewer. The reviewer is nothing but again a practicing chartered accountant with post-qualification experience of 15 years or so. I'm just giving you a gist. Technical reviewer will be appointed. Then technical reviewer will conduct technical review, will give the report to the quality review board. I've explained this in great details, this whole quality review thing in my lectures. All right, but I was giving you the whole background because they're asking you the quality review process from start to end. So if you just read this answer also, you'll get a gist about what is quality review. Then this is a particular module question, and this is one of their favorite question. If the quality review board notices major non-compliance, then what is the consequence? Nothing. They will just file a complaint with the ICAI, and then council of the ICAI will take action against you in professional ethics chapter under CA Act 1949. Basically, quality review board themselves do not have a right to ban you or so. All right. If the observations are not that material, they will just give you an advisory note. All right. If the observations are completely trivial, inconsequential, then they will just take the matter on record and close it. All right. Question number 25 is on professional ethics. All right. In the very first point of the question, the very first question. All right. They are talking about that you are the practicing chartered accountant, you are going to accept an audit, so you are the incoming auditor. Now, when you look at the financial statements of the company, the audit fees of previous auditor is outstanding. If the audit fees of previous auditor is unpaid, normally we do not accept the audit. However, there is an exception that in case of sick unit, we can accept such audit. Now, what is a sick unit? A unit which is in existence for not less than 5 years. And, when you look at the financials, its net worth is negative. Correct? Now, if you see this, it is in existence obviously for more than 5 years. And when we look at the financials, the net worth is negative, so it is a sick unit. So even if the previous auditor's fees is outstanding, the current auditor can still accept the audit. Next, this particular question is a practicing chartered accountant who has a website. And that particular website, all right, not website, there has a domain of that particular website. Website ka naam uske paas hai. Now, this particular practicing chartered accountant has sold this domain, and they are earning, this particular practicing chartered accountant is earning a royalty. So basically, practicing CA started making some business income from a separate line of business. Now, if practicing CA wants to engage into any other business, occupation or profession, all right, then in that case, they need prior permission of the council. Clause 11 of CA Act Clause 11 Part 1 First Schedule to CA Act 1949, read with the CA Regulations 1988. Now, if then CA Regulations, there are two resolutions, general resolution, specific resolution. General resolution, there are 14 activities. If it is getting covered in that 14 activities, then there is no prior permission required. However, if it is not getting covered in the 14 activities, then the prior permission is required. Now, this is not getting covered in that 14 activities of general resolution. That is why prior permission is required over here. And she has not taken any prior permission, and that is why she will be held guilty. All right. So that is the RTP of November 23. I hope that you were comfortable with this video. If there are any doubts, comments or so, you can just post it in this video and share it with your friends, because this is the most concise video on RTP covering all the points. Thank you so much.